Good afternoon, everyone. Thank you for taking the time out of your day to join us for our webinar titled Returning Back to Normal, Our Market Outlook for 2022. Nick Raich, CFO and CEO and founder of the Earnings Scout, is going to share his company's research and perspectives on the key variables to watch and potential impact that they may have on corporate earnings and markets and as we head into 2022. If Resolute Wealth Advisor is new to you, I'm Scott Holman. I'm President, Senior Wealth Advisor. Also joining from our team is Bo Bryant, who's a Wealth Advisor and our newest CFP. Congratulations to Bo. It's a huge accomplishment. And our presenter, Nick Raich. Before we get started, I'd like to turn this over to Bo, who'll just give you a few instructions on if you want to ask questions during the meeting, how to go about that. Nick will have Nick give his presentation, and at the end we will have time for questions. So Bo, I'll turn it over to you to explain to our
Yeah. So, like Scott mentioned, throughout this presentation, if you do have questions that come up, we'll be saving all questions until the end, but down in your chat box, you'll have the option to send a message directly to the panelists, which is ourselves and Nick. And so as things come up throughout the meeting, don't be afraid to type them in there. We'll address all the questions at the very end and get some input from Nick on that as well. So I'll go ahead and turn everything over to Nick so we can get started.
All right, I'll give a little introduction here first, Nick. And also, by the way, we are recording the session. We will have playback available, and we can send that out to our distribution list after this. But if you're on this program, you may have heard Nick speak at some of our past client events, or even at some of the community events he's attended here locally. Nick is a chartered financial analyst. He's a CEO and founder of the Earnings Scout. His company conducts global macroeconomic research and provides consulting services with a specific focus on corporate earnings trend analysis. His experience in corporate earnings research has resulted in numerous appearances on CNBC, Bloomberg TV, as well as in national and regional print media like the Wall Street Journal, Financial Times, New York Times, and Business Week. Prior to forming the Earnings Scout, he had over 15 years of experience as a director of research. Nick works directly with our team. He's an investment committee member for Resolute Wealth Advisor. He provides daily market updated research, and we all get together on a monthly call to discuss current market events, any implications we may want to update or change that impact our client portfolios. I think you're going to enjoy Nick's ability to turn complex data into concepts that we can all kind of walk away with and feel like we have some understanding. So it's my pleasure to turn this over to Nick.
Thank you, Scott, and thank you, Bo, as well. The title of the presentation is Returning Back to Normal. If we can ever return back to the normal that we once had, but part of the returning back to normal will be in terms of the market cycle, the corporate earnings growth rates, and things like that. Life as we know it may never return exactly back to the way we had pre-2020. But this quote from Sir John Templeton, I think, is one of the most simple yet eloquent ways of summing up a market cycle. And I want you to follow along with this quote through today's presentation to find out where we might be in terms of a market that's the S&P 500 is up over 100% since March of 2020. Small cap stocks are doing even better. And a lot of times people want to know when is it time to cash in? How much longer can this bull market run? And this quote, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So I want to find out where are we in this cycle, according to Sir John Templeton. And when we look at this is the graph of the S&P 500. since February of 2020. So when the COVID shutdowns were really going and the fear of COVID was at its peak in March and April of 2020, this green line you can see drops here significantly. It's 34% drop in the S&P 500. And the bottom, take a look where the bottom of stocks started, just like Sir John Templeton said, at peak pessimism, peak fear, if you will. This is when everyone was worried about COVID the worst in March of 2020. And that's the time you wanted to buy. So usually the time to buy, when it's time, you won't want to. And when it's time to sell, you won't want to. But if you take a look at that, we had peak pessimism for sure in March of 2020, right at the bottom. And then in the summer of 2020, this is a lot, by June and July of 2020, the S&P 500 had rallied 30-40% off of its lows. And this is the time when the shutdowns were at its peak. And so the economy was in a recession. A lot of people said, the stock market's disconnected from reality. We're in a recession and the market's up 40%. So you had that skepticism. And then I would say we had optimism about a year ago when the vaccines were first coming out and the reopening of the economy. That made a lot of people optimistic when the vaccines were coming and the businesses were going to come back and we would return to normal. Now, I don't know that we're at euphoria yet, maybe not necessarily in stocks, but there are some pockets of euphoria that I'm seeing. One of the biggest questions I have been asked throughout the course of my career is this like the .com era when a lot of craziness was going on? And I've always told people, no, it was much more crazy in the 90s. Up until the last several weeks and months, I'm starting to see some euphoria, but it's maybe not necessarily in stocks, but in other asset classes. Now, within meme stocks, there seems to be some euphoria, but I don't know that it's the overall market. We've seen these amongst some traders, active traders, younger traders that have bidded these shares up well above what their earnings and cash flows would suggest. But you've got euphoria in the cryptocurrencies. You have something like Dogecoin that was created as a joke that goes, as the youngins say, to the moon. Then you have these things. If you've watched non-fungible tokens, NFTs, more or less this is using the blockchain technology to authenticate art, digital art, JPEG files. This particular JPEG file called Everydays sold for $69 million. This is a JPEG file. This is not art you can actually hold. It's not tangible. It's a JPEG file for $69 million. So you start to see this kind of craziness when people get euphoric, when they have too much money. And then you have another thing with euphoria. Squid Game is very popular on Netflix. Someone actually created a cryptocurrency for the Squid Game, and it was up over 2,400%. And it turned out to be a fraud. So this is typical what you saw in the late 90s with euphoria, where there would be people trying to make quick money, people plowing it at the end, thinking they can't lose, and then even things that become fraudulent. You had this in the late 90s, early 2000s as well. So I am starting to see some similarities where you have a market bubble. And the Mark Twain saying history doesn't repeat itself because it rhymes. This is a chart on the screen here. You may or may not have heard. This is one of my favorites. This is the first known market bubble that in recorded history. It occurred in the 1600s in the Netherlands. This was tulip prices. And tulips, when I say tulips, this is not a software package. I'm talking the flower, traded to equivalent of $35,000 a bulb because people thought they had medicinal powers. People rushed to get it, and there was a mania for it. And you could see how that cycle goes. So it seems to be no matter what the human nature is, we're going to have these boom busts, and we're going to have things that get bid up higher than they should. So is it in stocks right now? Some of this money may be going to other asset classes like these NFTs, these SPACs, or into cryptocurrencies. But the third quarter earnings season, I want to update that. I do a lot of work with earnings season, and I want to dispel some myths about third quarter earnings because stocks are right near all-time highs. They ripped again today. You're talking, the Dow's put up almost 1,000 points over the last 2 trading days. And a lot of the strategists on Wall Street We'll talk about how the results are so great in justifying the earnings. And I want to say the results are very, very good. There's no doubt. But are they great? I don't think so. When you look at this, they look great relative to history in terms of their earnings scorecard here. With the 496 companies in the S&P 500 that have reported 37% growth. Now that's about 5 to 6 times normal. So yes, it's great. 82% beating estimates. That's normally 75%. So that's great. So when you look at it like that, the results look great. But we don't look at it just as a snapshot in time relative to history. We want to see it relative to the quarter before and the quarter before that. So while 82% have beat earnings estimates, and it's right here, there's that 82% flashing in the third quarter scorecard. What about in the second quarter earnings scorecard? So I'm going to look at the tail of the tape. 82% beat estimates this earnings season. 89% beat the quarter before. Advantage second quarter earnings season. The average earnings surprise, the companies beat estimates by 8.96% this earnings season. Last earnings season was over 17%. Advantage, we're going to give that again to the second quarter. Then you have the EPS growth, 37% is fabulous, 91% in the second quarter. Then look at the beat rates on sales, the average sales surprise, the growth rate in sales. And then this is the most important. After companies report their earnings, what are they saying about the next quarter? 39% raised estimates this earnings season versus 53% last earnings season. The average estimate change, minus 2.61%. They got lowered. They were going higher last earnings season. So what we look at here, by every known metric that is important to us, the results were less good than the quarter before. They're weakening. Some of this momentum is being lost. So as we look at that, clearly the second quarter earnings season was better in terms of every metric that we measure. All the while, even though this momentum is slowing, it's still positive momentum. We're still moving forward. Stock prices are soaring. So this is through yesterday's close, not counting the near 2% gain today in the S&P 500. So in the fourth quarter here, the S&P 500 is up 6.6%, 22% year to date, and 105%. Stock prices have doubled faster than almost every, during a period quicker than any periods of most of our lifetimes. You have to go back to World War II to see stock prices double quicker. And the Russell 2000 small caps are doing even better, up 122% off their lows. Now, is this justified? I want to talk about the mechanics of the market, and I want to show you how we look at the market and why we're getting cautious here, and think you should be taking some chips off the table in stocks and selling near these all-time highs. We're not bearish on the economy. We don't think the economy is going into recession, but we're going to show you where we think the market's a little bit ahead of itself and prone to any type of kind of unknown shock to the system. We have seen some 1,000-point drops here in the last week to 2 weeks, particularly the day after Thanksgiving, which is a short trading day. The Dow dropped over 1,000 points. That's because there's increased risk in the market, and I want to highlight that. But stocks are always, every day, speculating about the future. So today, the S&P 500 or the Dow was up almost 500 points. That means that's what the market's telling us today is the market thinks the Omicron variant is not going to be that bad and that the economy is going to be good now into 2022. Stock prices go up. It's always speculating every day about that. The variables that impact the future expected earnings change. So you have the variant of coronavirus, Omicron. You have Fed policy of credit. The Fed tapering back on its QE, supply chain disruption. These are all variables that impact future business activity. The speed of the markets trading has certainly gotten faster, but make no mistakes, every day the market speculates about the future. And no one knows for sure what the future is going to look like, but it's taking all the known variables and then taking those into account to try to predict what the future is going to look like. And that's what we're doing. In 2020, the variables were pretty simple. It was actually pretty simple to see the stock market. While you hit peak pessimism around March and April of 2020, there was only two real variables you really needed to have in 2020. And that was COVID-19. You needed those COVID-19 fears to ease. And then you got all this massive stimulus on the fiscal and monetary side. So we said the investment equation of 2020 was pretty simple. Virus fears easing plus massive stimulus. It led to improving earnings expectations. And improving expectations led to rising risk asset prices, which stocks are a risk asset. It was fairly simple in 2020, even though there was a lot of unknowns because you didn't know that the virus fears were going to ease so much. But we can measure that. The variables in 2021 are more. So in this, you have business reopenings, and you had them towards the end of 2020 and in the middle of 2020. But not just business reopenings here, but across the world. That's positive. Now we got inflation to consider. That's a new variable that we haven't seen in 2 or 3 decades. Supply chain disruptions are a variable. Monetary and fiscal policy are always variables. There's a lot of fiscal stimulus, a lot of spending packages, and the Fed is a variable. And then we had this Omicron. So you can have a variable that pops up, an unknown, if you will. We don't know that Omicron is going to turn out to be anything feared, but I think it should highlight to you, if any unforeseen variable comes into the system, just how quickly stocks can drop. We saw that over the last week and a half. The other thing that I want to show and highlight here, I got highlighted the S&P 500 growth estimates. These are the EPS growth estimates. And this is going to be interesting from this standpoint because I want you to see this. Earlier in the year, the estimates were going up. You could see in April, their fourth quarter was 12 to 15, going higher. But now we're getting these estimates going down from where they were on November 1st. And it's almost all of these periods. The estimates were higher on November 1st versus December 7th. So earlier in the year, the estimates were going up at increasing rates. Now they're getting cut on an absolute basis. The easiest way to see this, we show this on a rate of change basis on a chart, because you could look at the numbers and kind of just, they could look blurry after a while. The way we like to show it is in this chart. This is the same data, but what we do is aggregate it for an earnings score that we look at. And this is through last Friday, and this is showing the overall direction of future earnings expectations that we measure. And back earlier in the year, after companies reported their fourth quarter numbers from last year, in early February, we saw S&P 500, the average estimate change across multiple quarters out into the future was going up at a rate of 3.91%. And that was in peak fourth quarter earnings season when most of the companies report. Then they kind of don't report. You don't get any more revisions. The line drifts down. And then in peak first quarter earnings season, the estimates were going up at a rate of 5.15%. This is really important because this to us was the peak in optimism in future earnings. In terms of the way we measure that is based on the rate of change in earnings estimates. This is when they were going up at the highest rate. Now, they still went up in the summer at a rate of 3.43%, but what we're noticing is a slowing of the momentum. So, and the prices kept rallying. That's a 1 quarter divergence. We weren't too worried about that. But this earnings season and peak earnings season, we saw the rate of the estimates go down at a rate of 0.87%. So what we're doing, if we draw this in, when the estimates are going up at increasing rates, we think that justifies a rise in price. But now we're noticing on a rate of change basis, the momentum slowing. And so what we have here, this is a warning sign to us. We got a diverging trend. The belief in our model, from what we've noted from over 30 years of data, is when the stock prices should follow the rate of change to the earnings expectations, and they typically do. There are times they diverge, and when they do, you get this alligator jaw. So this alligator jaw opens, and that gives us a warning sign. We did not get this warning sign until really October of this year. That's when we could confirm an alligator jaw opening. How do we define an alligator jaw? We define that as 2 or more quarters in a row of diverging EPS estimate trends in price. So if you think about it, the expected profitability of corporate America for the last 2 quarters has been getting worse. And price keeps going, is today right near to an all-time high. Now look at this. Every major market sell-off of over 20% or more in the last 30 years was preceded by an alligator jaw being open. It's every time. So we've had big sell-offs, and when those have occurred, this is when we've had alligator jaws open. And this is the only time we've had alligator jaws open. 1999, we had an alligator jaw open. when we had the dot-com collapse, the S&P 500. That was the biggest time the jaw was open, the widest it was open. The S&P 500 fell 50%. It got cut in half. Dot-com stocks went to zero. Then in 2007, we had the financial crisis right before that. And then we also had a jaw open in 2014. We had a jaw open in 2018, 2019, and now. So where I said in the mechanics of the market, the speed of the markets change quicker. I think the cycles move quicker now too, because it took 8 years between 99 and 2007 to get another alligator jaw. Then it took 7 years. Then it took 4 years, 1 year, and now it seems to be coming almost every year and a half. So things are moving faster and faster in terms of the cycle. The bear market off of COVID, it's lasted 34 days. The sell-off from February 19, 2020 to March 23rd, 2020, you had a 34% drop in the S&P 500. It's the shortest bear market ever. So things move faster. But I just want to highlight, the jaw was open the longest and the widest in 1999 for 5 quarters. We're only at 2 quarters of divergence right now. We had 5 quarters in 99. That period to me was the most overvalued period that I've had in my career. So I don't see, while I'm cautious on stocks going forward, I'm not as bearish as I was during the dot-com era when there was a lot of euphoria in the market for sure. I want to take you in time to 2014. So what I'm going to do here is I'm going to go from 2014 to 2018 and 2019, and now to show you when the jaws were open over the last 5 years, what happened in markets. So in 2014, this is what those earnings trends look like. So I'm going to take you back in time. This is January 2nd, 2015. And what we had here is estimates were going up. They were improving. They weren't really going up. They were getting less negative. That justified a stock price rise. But then we had the estimate trend start to weaken at late 2014 into 2015, all the while price closed at near an all-time high at the end of 2014. So you had an alligator jaw open. Have an alligator jaw open of 2 quarters and more of diverging trends. The S&P 500 in 2015 was a poor year for returns that went nowhere. So you took a lot of risk to be in stocks in 2015 to go nowhere. And from the period May 21st, 2015, now mind you, the jaws open here at late 2014. You got a warning sign. The big drop in the market occurred from May 21st, 2015 to August 2015. You had a 12.35% drawdown. This is the least negative return when an alligator jaw was opening. So you had big drawdowns when the jaw was open to 1999, big drawdowns at the financial crisis. We had bigger drawdowns in 2018 and off of 2019, the jaw opening. This is the least stocks have ever fallen with the 2-quarter divergence or an alligator jaw, 12% drawdown. We have not had a 12% drawdown. I just want to highlight. I want to highlight what in 2018, you have this same jaw opening. So this is taking you back in time to the end of August 2018. And here you have earnings estimates going up, increasing rates. And in early 2018, you have this big bump up in estimates of 5.28%. The reason is you had the Trump tax cuts take effect here. So what they did is that bumped up the estimates. And then as the tax impacts wore off of the expectations, and Jerome Powell and the Fed kept tightening interest rates, kept raising interest rates. And what that did is it weakened the earnings expectations, and the price kept rallying. You had another jaw opening. And what happened here from 2018, Jerome Powell kept tightening rates into this with an alligator jaw open. It was a very dangerous thing he was doing. He was going to break the economy. So what happened in 2018, the Fed made that policy error. For the year in 2018, stocks were down 6.24%. And you had a 19.78% drawdown from September 20th to Christmas Eve. If you remember Christmas Eve 2018, it wasn't a fun day. The markets were tanking. That was the bottom in the market. But the markets were down 20% for that period with an alligator jaw open. And then in 2019, again, when we had another jaw open, as we do now, you had the estimate trends improving there at the beginning of 2019. And then the estimate trend started to weaken as the price was rallying in 2019. So this is just before COVID was really, it was starting to get known. It was known in China in November of 2019, but it wasn't really known to be in the US, even though it may have been in the US at this time. We downgraded stocks in December 2019, not because we saw COVID coming, but because of the alligator jaw. It was open. We know when the jaw's open, any kind of unknown variable that comes in, you got excess risk in the market. And we want to preserve your wealth. We want to help you grow your assets when there's green lights in the economy. We're getting a lot of red lights in the economy right now, and warning signs on the earnings front. But we downgraded stocks here because of that. And then when you had the COVID-19 shutdowns, you got a 34% drawdown from February 19th to March 23rd. Again, the quickest bear market ever. If you blinked, you missed it, because 2020 actually turned to be an up year in stocks at the peak losses. But at one point in 2020, you had a 34% drawdown that took a big hit to stock prices when people panicked. So I want to go back to where we are today. So I'm taking you back. This is through last Friday. This is the current data, what it's showing. And we have an alligator jaw. And I want to play out the scenarios that could possibly play out here to find out what can go on with stocks. And how will this jaw close? Now, keep in mind, this jaw always closes. It will close. And for it to close, there's 4 possible ways this jaw will close. Again, we don't really see the future, but what we do know is 3 out of those 4 ways are going to lead to lower sustained stock prices. And only one way will lead to higher stock prices that are sustainable. Now, that way, I'm going to lay out that scenario. Now, how will this jaw close? This is the most bullish way, and I'm crossing my fingers this actually happens, because I actually root for the economy. I want it to do well. I don't want to see the economy do bad. Even though we're cautious on stocks, I'm not rooting against the economy. So the way this plays out is we got to have this happen. This earnings trend line has to start getting better. We need to start to see the earnings expectations no longer fall, but start to go up, and up at increasing rates on a rate of change basis. That can close the jaw. That's going to be a sustainable bull market. I hope this happens. Hope is not a sound investment strategy, though. And for this to play out, it requires a perfect scenario to play out over the next 6 months. So what needs to play out under this perfect scenario that are going to lead to sustained raised EPS expectations again? Well, we need these supply chain and inflationary pressures to both abate at the same time. The problem is, part of the supply chain problems are because we can't get workers back at the wages they want. So you can't really solve the supply chain issues without it being inflationary. That's kind of tough to get, but you need both of those to abate. And then you have to assume 6 to 12 months from now, demand remains strong. Over the last week, if you recall, there's been a couple of days where the Dow's been down over 1,000 points or had 1,000-point swings in a day, just in the last week and a half, just from an unknown variable, the Omicron variable. That was impacting that demand would fall off. So if that doesn't happen, if there's any kind of unknown variable that comes in and impacts demand, stock prices, you can see what's going to happen. But it assumes demand remains strong. So you have to assume the Fed's going to stay accommodative. So if inflationary pressures abate, the Fed can keep its QE. The Fed can also keep interest rates near zero. That's probably not likely. The Fed's probably going to have to battle inflation. We think the Fed's been too late to raise interest rates, and it's going to be hard for the Fed to be accommodative. They've already talked about scaling back on their quantitative easing program. That's basically pumping in money through bond buying into the economy. They're scaling that back to fight inflation. The Fed has made a horrible call on inflation. They thought it was going to be temporary. They kept the punch bowl out in terms of easy accommodations, and now they might have a real inflation problem on their hand. And then the other thing is you have the Biden spending plans. That's fiscal stimulus. That's going to boost the economy. It's going to be great. I mean, that helps the economy. However, you have to hope it boosts the economy without being inflationary. So you got to have that play out. And then you cannot have an unknown variable like Omicron happen. And probably not. You got to hope it's not bad. It probably won't be. But there can't be something else. When you have this divergence, this alligator jaw open, there's no margin of safety left for stocks. This is where you hear people say stocks are priced for perfection. Stocks are priced for perfection today, and it's still playing out even with the rise today. So you could see when it gets that shock. This is when you have these big pullbacks in the market. We've never had a significant sell-off in the market of 20% drawdown or more over the last 30 years without an alligator jaw. So you can have unknown variables hit, but if you don't have a jaw open, the market goes down, you can have a correction that's not that bad, the market recovers. But when the jaw starts to open, this is when we get these big sell-offs that potentially in the market. So that's the most bullish way the market plays out. I hope that perfect scenario plays out. I don't see how it can, but like I said, I hope it does. But again, I don't want to make recommendations to Scott, to Bo, to the rest of the Resolute team, to all of you based on just hope alone. I want to follow the data. Now, here's another way the jaw can close. This is the most bearish way. I don't think the most bullish way is likely. I don't think this scenario is likely right now either, but this would be the maximum bearish case for me. The way we get this jaw to close is the price drops. So under this price drop, we could see, we think, an estimate of about a 25% hit to the S&P 500. I don't think this is likely. I don't think it's that bad. But if stocks fell 25%, if the S&P 500 dropped 25% over the next several weeks or months, I wouldn't be all that shocked either. I don't see a 30, 40, 50% drawdown like we saw the 50% drawdown during the dot-com collapse, because the jaw is not open that wide. That's one way. Now, another scenario of the way it's going to happen, you can start to see this happening right now, and I can see this playing out, is the estimate trends improve a little bit and the price comes down a little bit. This, to me, is the most likely scenario, this third scenario. And this is where we can see probably a 10, maybe a 15% drawdown in the S&P 500 that we're not there. And this is what we think was probably the more likely scenario, that the jaw closes this way. That's a scenario. And then the final way, and this could happen too. Now, it leads to higher stock prices in the near term, but we could see estimate trends continue to weaken and the price continue to rise. This is just a 2-quarter divergence right now. As I said, in 1999, we had a 5-quarter divergence, almost four or 5 quarters in a row. So this could keep going that way. The jaw could open wider. If that does, the risk is going to really be flashing. Instead of a 25% drawdown, you're talking now, you could see the overall market start to fall 30, 40, 50% or more if the jaw keeps opening wider and longer. There's going to be much less margin of safety. This could play out too, but if it does, and we measure the estimate trends continue to go south as the prices keep going north, this is going to be a thing where we're going to really start to tell you to take risk off the table and scale back more and lock in your gains more. That's a scenario that could play out. I don't think that plays out, but like I said, it could, because it's very difficult to gauge euphoria when people are going to be done. But that wraps up where we're at in this cycle. I really do believe what John Templeton is right here. He said this, 20, 30 years ago, that bull markets are born on pessimism. There's no way we're at pessimism anymore. That was back in March 2020 at the height of fears of COVID. The skepticism occurred in the summer of 2020 when we had the economy go into a recession and the market was rallying. People couldn't believe it. Everyone said it was disconnected from reality. Go back and look at all the reports. That's what we're saying. Optimism on the vaccines. We have to be somewhere right now between optimism and euphoria. But again, the euphoria might be in things other than stocks. So you might see that as well. So with that wraps up kind of the view of why I'm a little bit more cautious on the markets. I have a lot, 30 years of the earnings data to show when the alligator jaw opens, what happens. We know there's more risk in the market today than there was 3 months ago, 6 months ago, and a year ago. So that's why we're cautious. So with that, I'll turn it back over to Bo for questions that you may have for me or for anyone else on the Resolute team. We'd be happy to answer them.
Yeah, so appreciate it, Nick. It's always a pleasure to have you here with us and talking about these kind of things. Had a question come through talking a lot about domestic markets, U.S. markets. What are we seeing overseas in terms of, are we seeing similar divergences, or is there anything internationally that we should be keeping an eye on as well?
On the international front, I mean, the corporate earnings trends, the one thing I've seen, and this is getting more and more as the world has shrunk, ever really since the dot-com era, when globalization was taking hold 20, 30, 40 years ago. The correlations are going up. So the earnings trends are very similar across the rest of the world. But when we look at things like emerging markets, those shares have been beaten down much more. So there's not necessarily a jaw that's open as wide amongst the emerging markets. So if you notice one thing, Bo, when the market was selling off last week, 1,000 points in the Dow, emerging markets were outperforming the US. And one reason that is because the US has a wider jaw open. So there's probably more risk today that we see in US stocks over some of the international at this point when it comes in terms of the corporate earnings trends and price. Now, there's other risk of emerging markets that make them risky. But nevertheless, based on the corporate earnings trends, we would say the US is less favorable now than the rest of the world.
Okay, thank you for that. Another question here. Rising interest rates have, it seems like they're always a topic of discussion for us and for everybody in the industry, but do you think that this is the time where rates will actually go up? They're always talking about it, but it never seems to actually, when it comes time to do it, it never seems to actually happen. Is this year the year that it happens, essentially? So
it's even interesting today, Bo, when we talk about interest rates, the bond market, the Fed policy. So the Dow is up nearly 500 points today. The bond market was cautious today. Now, people were buying bonds or selling bonds, so that was good. But what they're doing is they're selling more bonds at the short end on the 2-year versus the 10-year. So the yield curve is the spread between the yield on a 2-year and 10-year. And it's used as a gauge, that spread, when it narrows, when it shrinks. That's the bond market getting cautious about the future. And when it widens, that's the bond market getting optimistic about the future. And so we're seeing that spread narrow, almost 80 basis points since March 29th of this year. Now, if you recall, now the bond market's really smart. Take a look when the peak in earnings revisions happened. The spread between 2-year treasuries and 10-year treasuries was 159 basis points right at peak earnings. Now we're down to like 80 basis points spread. So the yield curve has narrowed almost 80 basis points since this time. Is that coincidence with the weakening earnings estimate trends that have happened? I look at that. Now, that tells me the bond market's cautious about the economy, is cautious about inflation and interest rates if they're going to start rising, because the Fed has to start raising interest rates on the short end. The Fed is going to have to battle inflation, but now it's going to be at a period when growth is decelerating and the estimate trends are weakening. In my opinion, the Fed waited too long here to hike rates. Now it could have a potential inflationary problem. At the same time, growth starts to revert back to normal, to more normal growth rates. As I said, we had 90% earnings growth in the second quarter, 37% earnings growth this earnings season. That's going to be 19% next quarter, going to 9% in the first quarter, down to 0% earnings growth by the second quarter of 2022. So the growth rates are decelerating here. So to get rising interest rates in this period, you usually have that when the economy is getting better. It'll be very interesting here. Everyone's been forecasting rising rates, and it just hasn't happened. The bond market's been very cautious, and I think it's signaling seeing some of the same caution about the earnings and corporate outlooks that I'm seeing.
Yeah. And I guess to kind of piggyback off of that, what's you said you thought that the Fed made a bad call, with failing to raise interest rates when they should have last year, and so they go through this process of raising interest rates this year, and that doesn't turn out to be enough. What does that scenario look like in terms of what the economy is going to do, stock prices, and everything in relation to that?
Yeah. So initially, it was very good that the Fed waited too long to raise interest rates. They wanted inflation. They had the proverbial punch bowl out at the party for people to get drunk off of easy money. I want to take you back to 2018, because I think the mistake, and it's clear in 2018, Jerome Powell and the Fed made a huge error in 2018. And this is why we had that 20% sell-off in that Christmas Eve day sell-off in 2018. When the estimate trends were improving, the Fed was raising rates, very positive. Now, through the summer and into October of 2018, and even in December of 2018, the Fed kept raising interest rates when the trends were weakening and growth was also decelerating. So the Fed made the mistake of raising interest rates at a time growth was decelerating and the estimate trends were weakening. It killed the market. And that's why we had this big drawdown. Now, the Fed admitted its policy error without admitting its policy error in 2018, all the rate hikes they made in 2018. And they said they were going to do 3 and 4 more in 2019, in December of 2018. Not only did they not do 3 more hikes in 2019, the Fed came out and reversed all of its decisions in 2018 and started cutting the rates again. So to its credit, it led to improving earnings expectations, but it made a policy error. The Fed made the policy error this time, in my opinion. Do you see when the estimates right here are going up at increasing rates? The Fed should have been hiking rates back at this time last year. Why? Growth was accelerating. The estimates are going up at increasing rates. That was the time to raise rates. We had 90% earnings growth in the second quarter of this year, last quarter, in the summer. You don't think the 90% earnings growth for the S&P 500 could handle a 20 or 50 basis point hike from the Fed to show it was serious about inflation? And it didn't. The Fed waited. So the Fed waited too long. And I think it's now in a period here. Now we get the estimate trends weakening. And the Fed may have missed its opportunity. It might be in a tough spot here because growth is going to be seriously decelerating here. And you're going to see that over the next several quarters. It's still going to be growth. It's still positive, but it's going to be reverting back to normal. And if any kind of unknown variables come in here with inflationary pressures, the Fed could be in a tough spot. And we think they should have been raising interest rates, making the polar opposite mistake that it made in 2018 when it raised too much. It refrained this year from raising rates. And that may come back to haunt the Fed.
Mm-hmm. Yeah, good. Thank you for that, Nick. As far as I see, we don't have any other questions. If anybody does have any extra questions that they'd like to ask Nick while we still have them, feel free to type those into the chat there. I'll go ahead and turn everything over to Scott so he can send us out.
Great. Yeah, just to, this maybe gives you all a glimpse of how we operate as an investment committee, how we interact with Nick and get input for our decision making. Our most recent move was in October when Nick suggested to go to a cautious stance. We adjusted our portfolios to be 5% underweight our normal strategic allocation. And that was what it really had been occurring up to that point was our equity allocation in our portfolios had not been adjusted since September of last year. And with the growth in the markets, we were quite a bit overweight beyond where we would normally allow that to happen. And so while it might have been a little bit early to, pull back some of that equity position, we did it based on managing risk. And that's really how we use Nick's research, is to help us figure out when to tweak and adjust. We're always going to typically stay pretty darn close to our target allocation for our clients. But it really helps us in the decisions on when to rebalance. So that's been our most recent move in our current stance at this point, and we will continue to take his input as we as a team here at Resolute make some decisions. One quote I noted, Nick, that maybe I would disagree with you on, and that was that the variables in 2020 seemed fairly simple.
It was only two variables. They were simple. Yeah. Getting those variables right was difficult. Yeah, absolutely.
But they sure didn't seem simple when we were going through it. So
they never do. Hindsight's always 20/20. Right.
Yeah. But all that being said, 2021 has really been for markets. It's ended up being a great year so far, but it has been challenging. I mean, if you look at or talk to anyone running a business or involved in decision making, they are facing a lot of challenges. The good news is that many of them are saying our profits are better than they've been. We're hitting higher profit margins, but it's doing it, in a lot of headwinds, a lot of difficult things to figure out. But that comes back to our beliefs that being invested in stocks over the long run is the way to win, and that companies are very adept at trying to figure out how to navigate whatever circumstances they're in the middle of, and will adjust. And maybe there are times when it's tough decision making and it's hard to figure out the way through, but ultimately they do. And that's why you see our belief in that, markets work, companies exist to make a profit, and at the end of the day, give them enough time and they will. So with that being said, I want to thank everyone who was able to join us today. Nick, I want to really, sincerely thank you for sharing your research with our group. For any of you who was on the call today, feel free to reach out to us with any follow-up questions or concerns, or, questions on how this may impact you, or how it could help you in any of the decisions you're trying to make. So with that, I guess we will wrap up this session, and I wish everyone a good evening.
Thank you, everybody.